Here is the contradiction sitting at the top of every markets page in Britain this Friday, July 31, 2026. Apple has just reported record revenue, the strongest result the company has ever posted for this quarter, and the share price went down anyway. Not up. Down, and sharply enough that the story has run all day across Euronews, Yahoo Finance UK and the major wire services, with headlines describing the stock as plunging. If you have ever wondered whether the stock market rewards good news, this session is your answer. It does not reward good news. It rewards news that is better than what was already priced in. Apple comfortably cleared the bar on the quarter it has just finished and stumbled badly on the quarter it has not yet started. Over the next few minutes I will take you through what was actually said, who said it, why the market reacted the way it did, and what it means if you hold this stock, directly or through a pension you rarely look at. The mechanics here are important. Apple does not publish a formal numerical forecast in its results release. Instead, the guidance arrives verbally on the earnings call, where management gives directional commentary on revenue growth, gross margin, and the specific product lines. That is precisely where this went wrong. The completed quarter was a record. The commentary about the current quarter, the one running through to late September, was softer than analysts had modeled. Because the fiscal year ends in September, that quarter carries the early weeks of the autumn iPhone cycle, which is the single most watched period in Apple's calendar. A cautious tone on that specific window is not a small detail. It resets the assumptions inside every valuation model on the street. Within hours of the call, coverage shifted from record revenue to disappointing outlook, and by Friday morning in London the headline had settled into its final form: strong results, weak forecast, falling shares. Tim Cook went out and explained the weak revenue forecast directly, which is worth noting in itself. One line has traveled further than any other. As reported on Friday, Cook framed part of the problem as Apple having underestimated its own customers, meaning demand outran what the company had planned for, with the consequences that always follow: constrained supply, stretched lead times, and revenue that slips from one quarter into the next rather than disappearing. That is a very different problem from customers walking away, and investors do treat those two things differently over time. There is a second layer here that gives the day unusual weight. Yahoo Finance UK published a piece inviting readers to listen to Cook's first and last earnings calls as Apple chief executive, placing this call at the end of a run that began in 2011 when he took over from Steve Jobs. A softer outlook is one thing. A softer outlook delivered on a call being described as a farewell is a genuinely rare combination. This is not an Apple quirk. It is how large capitalization equities trade in 2026, and there is a clean recent example. On January 29, 2026, SAP shares plunged to a new low after its cloud revenue outlook disappointed the market. Same structure entirely, the business was not collapsing, but the forward number came in below what investors had already paid for. The reason is simple arithmetic. A share price is not a scorecard for last quarter. It is the discounted value of every quarter still to come. A record result for a period that has already ended changes the small first term of that calculation. A downgraded expectation for the periods ahead changes every term after it. That is why a company can beat on revenue, beat on earnings, and still fall several % before lunchtime. The past is already banked in the price. Only the future is still being negotiated. The immediate impact reaches much further than people who deliberately bought Apple shares. Apple is one of the largest constituents of the S&P 500 and the Nasdaq 100, which means it sits inside a very large share of global tracker funds. If you have a workplace pension in the United Kingdom with any meaningful global equity allocation, you own Apple whether you chose to or not, and today your fund moved a little because of it. The second group is the supply chain. Component makers, assemblers, and logistics firms across Asia read Apple's forward commentary as their own order book forecast, so a cautious Apple guide tends to ripple outward within days. The third group is everyone else in big technology, because Apple's outlook is routinely used as a proxy for consumer hardware demand generally. That is why one company's guidance can shift sentiment across an entire sector in a single session. So where does this go from here? Based on the evidence available today, the near term is dominated by three questions. First, whether the softness is genuinely a supply and timing issue, as Cook's underestimation comment implies, or a demand issue dressed up politely. Those resolve very differently. Deferred revenue returns. Lost demand does not. Second, the leadership question. Markets dislike uncertainty at the top of a company this size, and until the succession picture is fully settled, some investors will apply a discount for that alone. Third, the autumn product cycle, which lands inside the very quarter that has just been guided down. Historically, September and October results tend to reframe the entire narrative, either confirming the caution or making today's reaction look like an overreaction. Expect elevated volatility in the stock rather than a clean directional trend until at least the next set of results. Keep three things on your watch list. Watch for analyst price target revisions, which typically land within 2 or 3 trading days of a call like this and tell you whether the professional consensus sees a blip or a trend. Watch supply chain commentary from Asian component manufacturers, because those companies report on their own schedules and often confirm or contradict Apple's framing before Apple itself speaks again. And watch any formal announcement on the chief executive transition, including the timing and the internal or external nature of the appointment. If you are an ordinary long-term investor rather than a trader, the honest advice is that a single session move, however dramatic the headline, is rarely a reason to act. What matters is whether the guidance thesis is confirmed at the next results, not what the ticker did on Friday afternoon. Here is the sentence to remember from all of this. Markets do not pay for what a company has done. They pay for what it is about to do. Apple delivered a record on Friday, July 31, 2026, and was marked down anyway, because the story it told about the next 3 months did not match the story already sitting in the price. Add a chief executive transition and a call being described as Tim Cook's last, and you have a day that is far more about narrative and expectation than about the underlying business. Nothing here says Apple is in trouble. It says the bar was high and the guidance did not clear it. That distinction is the single most useful thing a private investor can learn from a day like today. If this breakdown was helpful, subscribe for clear, evidence-based market coverage, and I will see you in the next one.